We are only a fraction of the way through the housing market collapse. Economic data is starting to look very scary for the future of the housing market, and although we are seeing some price declines in recent months, the data does suggest that there is still much further to go, in which we could see a total collapse of the housing market in a similar event to the global financial crisis in 2008. We are starting to see a drop-off in new home construction, which is typically a leading indicator for where prices are heading in the future. The pattern that tends to happen in the housing market is that housing volume leads price, so when the volume of new homes being constructed starts declining, we typically see declining house prices follow this, but lagging behind by a year or so. Now, what we're seeing is the total number of housing units under construction has started to plateau from the sharp increase that we've seen over the past few years, signalling that home builders are starting to slow down. Now, what's even more telling is that when we look at specifically single-family units, a steep decline has already started to take place, falling from 828k in April 2022 to being 769k as of December of 2022. Now, why this is so interesting and more of a relevant indicator of where new home volume is heading is because single-family homes are smaller and less time-consuming to construct, which means that home builders get the construction done much quicker and can therefore act quicker on decisions around future builds. Now, multi-family homes, on the other hand, take a lot longer to finish construction, which means that we are still seeing many developments that are still under construction today, despite the planning and initiation of these builds taking place back when the housing market and economy in general was a lot brighter in late 2020 and also in 2021. Now, the fact that single-family homes under construction is declining rapidly does signal that multi-family homes is likely to follow, but it's just lagging behind for now. And ultimately, because house prices lag behind housing volume, we are likely to see house prices continue to follow this downwards trend for the foreseeable future. Now, what makes this even more concerning is the fact that home builders are experiencing record high cancellation rates, with a large US home building company, KB Homes, reporting a 68% cancellation rate for Q4 of 2022. Now, it is crazy to think that we are facing a situation where more people are walking away from their home contract than actually following through with it right now, and by quite a considerable margin as well. Now, if we look back over the past few years, this cancellation rate is far higher than what is considered to be normal, and even a lot higher than what we saw during the peak pandemic fear in 2020, where cancellation rates got as high as 43%. Now, this is leaving KB Homes in a difficult situation where there is still a lot of homes under construction and being finished, but supply of finished homes is rapidly piling up due to a lack of demand right now, making it hard to shift an already large inventory. Now, D.R. Horton, who are also one of America's largest home builders, also said in their latest earnings report that they are suffering from falling demand for new homes as well, and are having to resort to home price reductions and higher sales incentives for buyers in order to shift their growing inventory. And D.R. Horton also said that they are expecting both average sale price and also home sales gross margin to decrease further in the next quarter. Now, the fact that America's largest home builders are struggling to sell their homes right now points to a growing housing inventory in the coming quarters and falling prices for new homes as home builders scramble to sell off their stockpile of homes that they have in order to recoup cash. Now, one of the main things that is suppressing home demand right now is extremely high mortgage rates as a result of rising interest rates. Now, the average 30-year fixed-rate mortgage in the US is currently over 6%, which is down from the peak that we saw of around 7% in late October last year. However, still significantly elevated from levels that we have seen in recent time. Now, mortgage rates are so high still that you'd have to go back to 2008 to find the last time that they were at this level, which is of course during the peak of the global financial crisis. And it's likely that the 30-year mortgage rate will rise back up to the previous high of 7%, and if not, even exceed this for a period of time in the future. And this is because the federal fund rate is estimated to rise as high as 5.5% later on in 2023, which is up from the current rate of 4.5%. Now, a continued increase in the interest rate is therefore likely to push mortgage rates up even higher going into the second half of 2023, which will only financially suffocate home buyers even more. Now, higher mortgage rates means lower affordability for housing, as potential buyers will experience more expensive mortgages from the higher interest rates that they're going to have to pay on these mortgages. Now, this means that buyers will either have to take out a smaller mortgage in order to get the home that they want, and therefore have a lower budget for buying a home, or some people will simply not be able to actually afford to buy a home full stop, at these sky-high mortgage rates. We're seeing this housing unaffordability be reflected in the payment to income ratio metric, which is a great metric to look at when it comes to how over or undervalued housing is right now, taking into account the wider economy as well. Now, as we can see from this data, right now the payment to income ratio is at 34.8%, which is the highest it has been since the late 1980s, and is still even higher than the peak that we saw during the global financial crisis in 2008. And this is despite a slight fall in the ratio that we've seen over the last few months to correlate with the small drop-off we've seen in mortgage rates and gradually declining home prices. Now, there is still a long way for home prices to fall if we are to see the payment to income ratio get back to a more historic normal, because right now many people are being squeezed to a limit with cost of living, and many cannot afford to actually buy a home at all right now. Looking at this updated Redfin data taken from over 400 areas in the US, we can see the continued slump in the housing market across many metrics, including median sales price, which is now down to $346,000, on par now with levels that we saw midway through 2021. Now, this marks a continuation of the sustained fall in median home sale prices that is now vastly lower than the levels that we saw in summer of 2022. It shows that homes are no longer flying like hotcakes, and instead there's been a slump in demand coupled with excess in supply on the market. Now, buyers cannot afford to spend what they once could due to mortgage rates, and home prices are falling to reflect this. With mortgage rates likely to remain as high as they are right now, or if not even rise higher, this continued drop in average sales prices is likely to continue as new home supply from the builders keeps hitting the market with no demand there to match it. As a result of this shift in supply and demand, the number of unsold homes has been building up over the last year or so, and the months of home supply on the market has now reached 4.1 months, levels that we haven't seen since mid-2020 when we still had a lot of pandemic fear. Now, this is a sharp rise in the supply of homes on the market, up from around 1.8 months early on in 2022, and shows just how bad the build-up in supply has gotten due to people struggling to sell their home right now. And with the influx of new home supply hitting the market from home builders that I mentioned earlier, this supply is only likely to continue building in the near future. The number of home listings that had their price dropped remains moderately high at 5.1%, which is far higher than anything that we saw in 2020 or 2021, despite being slightly lower than the peak that we saw at the end of 2022. Now, alongside this, homes continue to sell for lower than their listing price, with the average home selling for 97.7% of the final list price, the lowest that we've seen since 2020. Now, this shows that on average, people selling their home are choosing to take a lower offer than what they were originally asking for, and does suggest that there is not only a lack of competition for buying a home right now, but also that sellers are becoming desperate to sell up and are concerned with the direction that the market is heading in. A few other leading indicators that Redfin do mention too is that mortgage purchase applications are down 6% from a week prior, which is quite a sharp drop-off, and also they are down 43% from a year ago. Now, this does mean that the number of people looking to take out a mortgage is down quite a lot from last year, and has also just taken a sharp fall compared to a week prior, which could take a hit on future demand even more. On top of that, the Redfin Home Buyer Demand Index, which is a measure of requests for home tours and other home buying services from Redfin agents, was down 1% from a week earlier, and is also down 22% from a year ago, despite being up 17% from October of 2022. Now, overall, people are touring homes much less compared to a year ago, despite home tours going up in recent months. And obviously, if mortgage rates do stay where they are right now, or even get higher, as I believe could happen, then the amount of people touring around homes is going to obviously stay quite low and even drop off even more. And that is all for today's video. Be sure to leave a like if you did enjoy the video, as that does help out a lot. Also, drop me a comment as well. Let me know what your thoughts are on the current state of the housing market. And be sure to subscribe as well if you want to see more videos similar to this in the future. And thanks a lot for watching.